All right, welcome back to Stock Tricks with Nick for this week's Midweek Movers live stream. In today's live stream, like every week, we'll go through a general market outlook, take a look at the NASDAQ, S&P 500, IWO, which tracks growth stocks, ARK, which is another kind of growth stock ETF that I keep track of. We have a lot to cover with earnings, Netflix last week, Microsoft today, and then Tesla and Apple upcoming. And then I do have a list of 10 stocks or so that I have on my general watch list. Right now I'm sitting in 100% cash, and I have been the past couple weeks. The trades that I've been doing have been mostly day trades. Don't want to hold anything overnight just because we're in a very volatile market right now and a low probability trading market. But I do have a list of 10 stocks that we can cover that I've been setting alerts for, keep an eye on. So if we do get a general market uptrend in the next couple days, weeks, I have a focus list to go from. After we go through the watch list, we should have about 30 minutes or so to go through any stocks that you guys want to see. So please use the chat and recommend any stocks that you want us to break down. We will be using MarketSmith, which is the sponsor of today's live stream, to break down any of the stocks, and we can go through fundamentals on the bottom here, group strength, fund ownership, a bunch of great trading statistics. So I use MarketSmith for all of my trading research and then actually put in my orders with Thinkorswim with TD Ameritrade. But if you guys want to try out MarketSmith after seeing it in the live stream, you can use the link in the description below. Try it out for 3 weeks and just for $20. All right, with that said, let's get going. We'll start with the NASDAQ, QQQ. If I open this up, makes it a little bit easier to see, I think. And let me know if the volume's off, anything like that. Just let me know in the comments how everything's going. So QQQ, we broke the 200-day simple moving average. That was on Thursday. Kind of surprising. We did not have much support at that area. We cut through it cleanly on Thursday, and then Friday closing at the low of the day. This kind of cascading down, I didn't think would last forever. I assumed we get another kind of oversold bounce like we got on the January 10th through the 12th, and then continued down. But on Monday, we gapped down. I think we gapped down 2.5% or 3% at the open and pushed lower, finally putting in, at least for now, what the lows are. And then we rallied the rest of the day and closed right at the high of the day, which was basically the best reversal that you could ask for. We closed a little bit green, but this action is still super volatile, very tough to trade, very tough to hold anything overnight. And you saw that because just the next day, after this great reversal, after all of the bulls were celebrating that the sell-off is over, we gapped down 2%. But when we gapped down 2% today, we pulled back a little bit more. I think it was down 3% at the low. But then we pushed through the second half of the day and closed, let's see, it has the stats here. We closed 37% within the daily range. So 100% would be at the top of the range. Like yesterday we closed at, let's see. Yesterday we closed at the 97th percentile. Today we closed at the 37th. So in the lower 40% or so. Ideally, we would have closed higher, but we did have Microsoft earnings coming up and with after hours, so we expected a little bit of volatility there. We'll get to Microsoft in a second here, but want to go to the S&P 500 next. This one's holding up much better than the NASDAQ since it is more of tech that's selling off. But similar to the NASDAQ, this broke down on under the 200-day simple moving average. This on Friday, where the NASDAQ broke on Thursday. Closed at the low of the day on Friday. We got that gap down, but rallied. And then today closed in the 59th percentile of the range. So S&P 500, 59th percentile. NASDAQ, QQQs, 37. S&P 500 near the 200-day simple moving average. If we go back to the NASDAQ, you can see we're well below the 200-day simple moving average. So what is that telling you? It's telling you that tech is weak right now. There's other kind of patches of the market, oil and gas, energy, insurance companies that are showing some good strength. But overall growth stocks, as you'll see in a second here with IWO, are not the place that we want to be trading aggressively or holding anything overnight. IWO, this tracks the growth ETF, or this is a growth ETF. And I like to see the weekly chart here because it just shows you how in 2021 we were basing out, finally broke out of that base to the upside on November 5th, the week of November 5th. And then right after we started selling off, we had a weak bounce and then just undercut the lows in the base. And now we have a base failure, looking to find some support, potentially, let's see, when was this? Around September of 2020's highs here, the previous resistance, hopefully now support. So IWO not looking great. ARK-K, another growth ETF, absolutely not what you want to see, based out. And then this sold off before IWO, before the S&P 500, before the NASDAQ, all that stuff. And then this has gone from, I think it was like 159-ish, all the way down to 65. So this is a reason why I don't like to hold any stocks that are starting to work against me. I have clean stops at 7% max. Typically, my average stop loss is 2 to 3% when I get into a trade because I have no reason to hold a losing trade. That's the only way that you can make sure that you're not going to hold through a 30%, 40%, 50% decline is to cut your losses quickly. And in 2022, I've been doing that, but even quicker. I think I've only held one or two stocks overnight. And with those, they were sold the next day. So the average holding day has been less than a day for me. And that's the only way that I've been able to trade in 2022. And you can see it's basically a day trader's market at this point. With all the volatility, with the wide ranges, there's plenty of ways to make money as a day trader in this market. But as a position trader or a swing trader, we're getting 2% gap downs in indexes. That could be 5% in growth stocks. There's no way to manage your risk overnight. So it's not something that I want to be participating in. We're in a low probability trading environment if you see my TikToks that I post each day. All right, with that said, let's go through some earnings. So Netflix, that happened last week, didn't get to cover it, but it was down 22% on the day. Even worse, or not even worse, but we pulled back the next couple days as well. So this had been one of the stronger names in the market for a long, long time. But the leaders of one bull market don't typically lead for the next bull market. Mark Minervini always says, and now we're starting to see it here. That's a ton of selling volume. Not a stock that I want to trade. And this kind of at least hinted at the fear in the market for Microsoft. When they reported earnings today after the close, from what I saw, that they reported positive earnings, beat expectations, and before they released their guidance, before the actual earnings call, they were down 4%, and the NASDAQ was down another 1.5% after hours. So there is some fear in the market, even though Microsoft reported good earnings before they actually released their guidance. So let me jump over. I want to see what they're at after hours now. So after hours, they're up 1.2%. Again, they were down about 4 or 5% at one point before they released their guidance. So good to see that is up. I would much rather be trading with Microsoft holding up because we do have Tesla's earnings tomorrow after hours. This chart also looks very volatile. Not something, I guess before I talk about this, for new people following me or new people tuning in, I never want to be starting a position before earnings. Puts, calls, I don't trade options, but I don't want to be shorting a stock. I don't want to be going long a stock just before earnings, because in the earnings, just like I talked about with overnight risk, there's kind of a binary event. They could beat and the price can go up, or they can, I guess technically, they don't even have to not beat their earnings or disappoint on earnings, but if they are guided lower, like Netflix, you could be faced with a 20% decline in some of these growth stocks. And if you can't manage your risk with stop losses overnight, that's not a way to be a consistently profitable trader. So Unless I have 10% profit or more going into an earnings call, I won't hold a position. Even then, I learned with Coin last time, they had great earnings, but they declined 13% after hours. So even at that point, I probably am going to be taking half the position off or something like that going into earnings. Too much volatility and that overnight gap down uncertainty. So with that said, you can do whatever you want. You can play earnings, but not for me. Not for someone who wants to manage their risk very tightly. So with Tesla, we're under the 50-day, 21, and the 8-day EMA, all here. We did close just above 900 at 918 today, and above the 200-day simple moving average. That's another area to watch, but we'll see. Earnings is going to really change this all around. It could gap up, could gap down, and whatever Tesla does and Apple the next day, we have earnings with Apple on Thursday afternoon. We're going to see how it goes from there with the market. But these major tech names are going to be guiding the market for the most part, along with the Fed meeting tomorrow. I think they were meeting earlier today. I wasn't checking the markets too much today, but I don't believe there's going to be an interest rate hike tomorrow. I think they were talking more about March. But they're going to lay out their plan a little bit more. And as long as they stick to kind of the plan that they put out in December, I don't think there's going to be much of a change in the market due to the Fed. But we're in a very news-driven market right now with with very volatile daily ranges, with overnight gap ups and gaps downs. Not a market to be trading aggressively, especially if you're a swing trader. If you're a day trader, you love these wide ranges, but you don't want to be holding any risk overnight. All right, those were the 4 earnings that I wanted to cover. Now we'll get to the 10 stocks or so on my general watch list. And then I don't see any stocks in the chat right now, but if you guys have any requests, we can go through any stocks that you guys want to see in the hour. So just drop them in the chat and we'll go through what we can. All right, first we have AA. This is in mining and metal ores, 27th strongest group out of 197. We're always trying to find the strongest stocks in the strongest groups to increase our probability with the trades. So it's got a group strength rating of A, accumulation distribution B+. That just means the higher volume days come on days where the stock was actually up versus high volume sell-off days that you see in tech the last couple of weeks. So B+ is solid, but obviously the more probability we can stack in our favor. So if that's an A+, composite rating, that's a 98. It only goes up to 99, so that's great to see. We also have a relative strength rating, individual relative strength rating of 99. That's awesome as well. We always want to see those numbers in the 80s to 90s to improve our trade probability. Taking a look at earnings, want to go over that. Earnings per share were up 443%, over 1,000, 275, and 862. So great comparisons year over year for the last 4 quarters there. Sales were up 21, 32, 31, and 40%. And after-tax profit margins 5, 10, 12, and 14. So we're seeing acceleration of profit margins, which again adds probability to the trade. Want to look at fund ownership next. If we could get big money flowing into the stock, again, we're always stacking the probabilities for the trade, right? So if we could get fund ownership increasing, funds can't take positions all at once. They typically will add as the stock pulls back to key moving averages. So that's why you see with AA, fund ownership has been increasing. We went from 452 in December of 2020 to 662 this December. You can see as it flushed down to the 50-day simple moving average. This red line, buyers stepped in, supported it. We closed at the high of the day, similar to the general market, but then not similar to the market today. This gap down just slightly and then rallied to break over both the 8 and the 21 EMA and closed in the 92nd percentile of the daily range. So this is super strong. What I want to see is if it pulls back to towards 60, I want to manage my risk against that area, that $60 area. Let's check a 10-minute chart to see. So there was a lot of noise around 60. That's not ideal. I would have rathered it cleanly broke over 60, and then maybe came back and got supported above that area. maybe have to put a stop a little bit lower if we're going to try to buy a pullback here. But still one of the stronger stocks. Number one strongest stock in that group, again, an A group strength rating. Number one on relative strength, number three on composite. So strong stock in a strong group, something that we want to keep an eye on. AA. Next, we have Dutch Bros. This is starting to come back to life. If you've been following before, you know that I don't trade any stocks under their 50-day simple moving average. So you see this red line appearing because it just IPO'd last year. And today we actually rallied up on heavier than average volume and got stopped out right at 50 and right at the 50-day simple moving average. I guess the high was 49.98. So that gives us a clear pivot to work with. If we can, what I would love to see is a day or two tightening up below $50 and then breaking over both the 50-day moving average and $50 as a potential entry point there. Dutch Bros was a stock that I traded in 2021, had good success trading as it climbed higher and higher here, and then it kind of fell apart, went under the 50-day as the 50-day appeared, and has been basing out since. But the type of volume that we saw the last 2 days, with yesterday being a bullish engulfing closing, closing range 100%, closed at the high of the day, and then today closing in the 83rd percentile, where the NASDAQ was closing at the 37th percentile, was the S&P again. S&P was in the 59th percentile. So if we're looking for relative strength, we're looking for stocks closing higher in their daily range than the indexes, stocks that are above key moving averages compared to the indexes being below, stocks that are moving up on heavy volume versus stocks selling down on heavy volume. So Dutch Bros is starting to build a case there. What it has working against it, it's in retail restaurants, 159th strongest group out of 197. So it's a D group strength rating. But within that group of 53 stocks, it's the 15th strongest on relative strength, 7th strongest on composite. So it does go against the grain of that group. Earnings, they were negative, then plus 900, plus 400, plus 75 year over year. Sales 49, 49, 53, 50. And after-tax profit margin turned it around from -7 to plus 17, plus 13, and plus 9. So like I said, I want to see, ideally, we'll see this tighten up for a couple days under 50 and the 50-day moving average. Then a potential buy point would be a break over 50. Let's go. Next is CARS, cars.com. Another weaker group, and this is definitely not on like the actionable trading list. I just wanted to note it because it did break out on heavy volume, and now it undercut the previous low, and it just needs to base out a little bit here. It's above the 50 or 200-day simple moving average. It still hasn't closed that gap, so ideally that gap doesn't close, and we get more strength coming in. But it's not ready at all to trade. Just wanted to put it on your radar if you don't have it. I would rather pay up for it and buy it closer to $16 as it's moving up the right side of that base. But good shakeout here under the previous pullback, like a lot of stocks got on Monday, and now we need to consolidate and then start forming up to the right side. So that was cars. Then we get to a bunch of energy names, energy and minerals. So instead of tech, what's leading the market right now is oil and gas. That's the 5th strongest group out of 197. So it's an A+ group strength rating. And before we get into that, let's just go through the strongest groups in the market. MarketSmith does a great job at ranking them. And you click on, here, we'll go back to like Tesla. You just click on the group that it's in, auto manufacturers, and then it comes up with the lists of each of the individual groups, 197 groups, and then you can rank them and sort them by the industry group rank. We'll switch it around. Come on. There we go. So first we have oil and gas. Next we have media, periodicals. What is even in that group? There's only 3 stocks. Ignore that. Energy and coal, oil and gas, oil and gas, oil and gas, different groups of oil and gas. Retail, super mini markets. I think, is Kohl's a part of that group? Not sure. And then banks, chemicals, wood products, transportation, shipping, none of the heavy tech names. So without tech leading, we don't want to be focusing on tech if we're going to be trading or position trading. We want to be focusing on the strongest stocks in the strongest group. So right now, that is oil and gas and some minerals. So let's keep our focus there. Let's go back to DVN. So this is in the 5th strongest group in the market right now. You can see almost made a new high today, which is super, super impressive. It has earnings in 21 days, so we're not bumping up against earnings too early or too close. Group strength A+, accumulation distribution B+, composite overall rating 98, relative strength rating 99. Whenever both of those are in the 90s, we want to have it on the watch list or a general watch list, maybe not like actionable, but just a general watch list. Let's go over earnings. They were negative 97 to plus 650, plus 433, and then plus over 1,000 year over year. Sales turned it around, minus 19, minus 2, plus 513, plus 225. Then after-tax profit margins basically flat to 15, 17, and 21. So we're seeing acceleration of profit margins as well. Let's see. So within the strongest or 5th strongest group in the market, this is number 1 on relative strength and 15 on a composite rate basis. Check fund ownership to make sure that's increasing, and we do see it increasing. December 2020 was at 880. Now we're at 1653, so almost 100% fund ownership increase over the last year here. And similar to, Similar to AA, I want to see this come back to this nice round number, $50, and then kind of manage my risk against that. So if I buy just with a break into new highs, let's see what that would be. The high was $52, so that'd be a 4% risk because I want to buy with the breakout over 52, get my stop just under 50. There's a 4% risk to manage there. But these last 2 daily bars are so heavy or so wide that ideally we get a couple days where this tightens up, allows that 8-day exponential moving average to catch up, and then we could play that break after a little bit more consolidation versus a bounce from 42.30 all the way up to 52, almost a 20% bounce there. But DVN nearing a new high for at least the year. Let's see. Go to the monthly chart. Yeah, so nearing a new high since 2015 there. So let's keep an eye on that one. Definitely showing great relative strength right now. Another one that I wanted to mention was gold. So GFI. I want to go to the weekly chart on here because it looks just so pretty. Really, really nice structured base here. We consolidate and then we undercut the low of the previous pullback. So undercutting the low here, shaking out any of the weak hands. Then we bounce up and now we're tightening up right through here. And this was actually kind of buyable today with a break over, is that Thursday's high? Monday, Friday, Thursday. Yeah, Thursday's high of 1127. I didn't take it. I'm not trying to get too many long positions right now, but this is a very solid base in a non-tech name that is starting to really tighten up and then push out. So let's keep GFI on your watch list. GLD, same thing. Kind of see the base tightening up there. Basically just wanted to throw gold out there as an idea. Next we have a semiconductor which has been rapidly falling in relative strength as a group. It was the 3rd or 4th strongest group. Now it's down to 65 because NVIDIA and AMD have fallen below their 50-day simple moving average and maybe even their 200-day. NVIDIA is right on the 200-day and AMD is right on the 200-day. So within the group, PLAB is showing good relative strength, and I think you could see that. Yep, 3rd strongest stock in the group of 32 on relative strength, 3rd strongest on accumulation distribution, and 6th strongest on composite. This is a stock that I traded in 2021, right at the end of the year. As it broke out over 18 on this day, I started a position and then sold some of this strength, got stopped out on one of these days. I think it was the 7th. I forget what day I got stopped out, but This could be going one of two ways. What I do like is it's above the 50-day simple moving average, where a lot of the other names in that area are not. So it's showing good relative strength, but the group itself is weakening. So if this is kind of faking strength, let it flag out above the 50-day moving average, and then a potential short would be if it breaks under the 50-day, and then we have this gap to fill. So right now it's on my kind of relative strength watch list because it's above the 50-day. It's holding the gap up right now, and it did bounce on the 50-day on Friday. On Monday, it never even made a new low, which is, again, a sign of strength. But then today we closed at the low of the day, down 5%, and the daily range was 11%. So I'm trying to stay really open to this because it could be a name that you could trade either direction. So I'm not trying to have a bias long or short at this point, but if we break under the 50-day, that's a potential short. Or if we start to build out the right side of the base, this one's holding up better than the others if money comes back into the semiconductors. We got SG, also a retail restaurant. I think that's the same group as Bros. Yes, it is. This one, also an IPO, took out the low just recently on Monday, and then really good volume the last couple of days, breaking over 30 and then holding that move today, or closing back over 30 today, up 2.4% while the market was down 2-point-something%. No positive earnings to work with. Sales starting to turn it around, but after-tax profit margin still negative. Not in a strong group, not strong accumulation distribution. I don't think they get that super well for IPOs, so a little hesitancy using that. But just a name that I want to put on the watch list, or general watch list, because it could have just rolled over on Monday, but it fought back over a bunch of daily highs, over 30, nice round number, and then today it closed back above that as well. So not actionable, really, not looking to trade it this week, but want to have it on the general watch list. Got three more for you, and then keep on coming with the chart requests. Next is WLL, Whiting Petroleum Corp, fifth strongest group. Again, this is in oil and gas. Earnings phenomenal, 764, 213, 221, and then over 1,000% year over year. Sales turned it around, minus 44, plus 26, plus 284, plus 118. And after-tax profit margins, 26, 35, 34, and 35. A plus group strength rating, C accumulation distribution. There's a lot of heavy volume days coming recently. Some of them closed just slightly negative. I don't know if that's impacting that metric. But what I really, really care about is the relative strength rating. That's at a 99. It's above the 50-day moving average. Today, it closed back above the 8 and the 21 EMAs. You will not find many stocks that are doing that right now in the market. So these are what's showing the best relative strength. And if I'm going to put my money in the market, that's where I would want to find my money, or put my money in. Let's check in the group. This is tied for first out of 56 stocks on relative strength, 15th out of 56 on composite rating. Fund ownership stayed steady from September to December, 405 to 406, was climbing before that, so we'll see if next quarter that jumps up. But for now, steady action there. You can see it bounced at the 50-day, broke over both of those 21 and the 8 EMA, and then did the same thing today. So if we open lower, then take out the high, that would be 75.05. That a potential buy point there. But again, the market itself is not in a very favorable place. So if you have to trade, we're looking for stocks in the energy, oil and gas, those kind of sectors. But the beauty of it is you don't have to trade. You can wait until the market improves, your probability improves for swing trades, and then otherwise just kind of, if you have to, day trade along the way. But still have to manage your risk. And if we have to put our money in the market, right now, oil and gas is one of the strongest groups. Got two more. I don't know if this one's ready just yet, but Victoria's Secrets gapped up, let's see, December 29th, just before the new year. Eventually filled the gap on Monday when everything flushed lower, but then we rallied back above the 50, the 21, and the 8. Today, basically some sideways action, tested the 50, bounced there, closed right on the 8 and the 21 EMA on less volume than yesterday. Kind of hard to have more volume than yesterday after the craziness. But this is one where potentially a break over 55. I would rather buy it a little bit later as it builds out and test 60. One thing that a lot of new traders struggle with is the lowest price is not always the best price. As swing traders, we want to get in when it's the easiest time to make money, not at the lowest price. Because if you're trying to find the lowest price, I mean, let's go back to QQQ. You're buying the dip at the 50-day, and then it bounces, or you're buying the dip here, little bounce. You're buying the dip at the 200-day, it closes even lower. We don't know where the low is, and I would rather not spend money trying to find the low. I would rather try positions that are making higher highs, higher lows. Fundamentals are strong. Fund ownership is increasing. There's strong stocks and strong groups. Align as much probability on your side before taking the trade. And then even after that, you know it's just a probability game, so you have to manage your risk with stop losses, with correct position sizing. If you're a new trader, you shouldn't be losing more than 1% of your total capital on any given trade. So what do I mean by that? I don't mean you just have to put 1% of your account in a trade. You can put 10% of your account in a trade, use a 10% stop, and then that 10% times 10%, that's 1% total. Really trying to at maximum 1% of your total capital at risk at any one given trade is a great way to stay in the market for a long time. And I wish, I'm kind of talking to past Nick, I wish I would have known this because it would have saved me money and time along the way. Last name that I have is NEWR, Computers Software Database. This is one of the only tech stocks that are really holding up relatively well here. It's still under the 50-day simple moving average, but you can see it's basing out pretty well. These daily bars are all over the place. You're going to see that with the volatility in the general market, but this hasn't completely collapsed here. It looks like we're starting to build the right side of the base. Maybe we're at the midpoint of the base, but we have earnings in 14 days. Maybe this is one that it just kind of builds out, and then we get a power earnings gap to play off that. Similar to the last earnings here, popped, kind of fell short, and now starting to base out. So no clear entry point. Earnings in 2 weeks. Maybe a break over today's high would be a break over the 50-day moving average as well. But again, the market itself is not right. So if the market is not right and in an uptrend, you're going to be swimming upstream as a swing trader. So I would rather just keep listing stocks that are showing good general strength or relative strength, and then once we do see some consolidation in the market or an oversold bounce, consolidation, get our follow-through day, that's when we start want to press on the gas with some swing trades. All right, those are the 10 or 12 stocks that I have on my watch list. Let's see what you guys want to see. NEM. Newmont Corporation, mining gold, silver. Yeah, so weaker group. Same with the gold. It has been for a while, but let's see here. We undercut the low of the previous pullback. We're back above the longer duration moving averages, the 10-week and the 40-week. Let's go to the daily chart. Good daily volume, enough to keep it liquid. Yeah, this looks strong. It just doesn't trade super well, though. Like, I'm not an expert on oil or gold or mineral. Like, I usually just trade growth stocks, so the fact that these daily bars are kind of gapping and all over the place, I'm going to be more hesitant to trade these until I get more familiar with how they trade. Or by that time, growth stocks will be on the way back up. So we'll see. This is where the money's flowing in right now and has the best charts out there. So I wouldn't be surprised if this continues higher. I just don't know if I want to trade it. And I have it on my watch list, but I don't know if I want to risk the capital because I don't know exactly how these stocks trade. I have not traded them much in the past. Let's see. When Jim Cramer says to buy at these levels, you know the market's going down a bit. Yeah, he's a great entertainer, and that's all his show should be for you guys. Any names that you're focusing on? Yeah, DVN, we covered that before I saw your comment. Venom, same idea, very strong. If you're going to trade these, or if you're going to trade in this market and try to find like positions or swing trades, oil and gas, that's where the money's flowing right now. And then what I've been doing a lot of is I've actually been shorting some of the weaker names just whenever they pop up to like key moving averages. Peloton, this is a stock that I traded today. After it was down, 24% last week, it rallied back up to the 8-day EMA. And then let me go to like a 10-minute chart. And then this actually held. So the market gap down, this held, and then bounced, let's see. No. This is today, sorry. Flagged out here, and then eventually, just off the first 5 minutes, lost that, and I made 1% of my account shorting that, closed it out, didn't ride it all the way down. I've been really bad at like missing out on longer moves on the short end, but it seems like we're so oversold in the short term that we're due for an oversold bounce. So right now, I've just been trying to kind of make quick money, stay as out of risk as possible, but finding some of the weaker names, basically anything that ARK owns, SE, Roku, Teladoc. These are all names that over the last 3 weeks, I've been basically like day trading on the short end. And if that's not your thing, you don't need to trade every day. I did it to make a couple bucks here and there. I'm up like 5% on the year. Nothing crazy. Just a way to generate some income. But until the market gets right, holding anything overnight is not going to be something that I want to be doing. XLE, let's see. Yeah. I think Minervini said he started a position in XLE and was it Gold GLD today, something like that. And Minervini's the champ, so whatever he's doing, I'm at least paying attention to and listening to. Do you think that the time the stocks hit 99 RS in MarketSmith, they're typically too extended? No. That's a good question. I would actually say kind of the flip side. They stay at 99 relative strength longer than they're actually at that because it's a year-long rating system. So stocks like Upstart, they're now at 21, but when it was like here, it was still at a 99 relative strength because it took the entire year into perspective and it was above 99% of all the stocks in the market. So I would actually say kind of the flip side where stocks will stay at 99 or 90 up in the relative strength rating even while they're in clear downtrends, and that's stocks that we should avoid. But stocks that are hitting 99 on the way up are still stocks that I want to be considering, especially if they're just pulling back to a key moving average and they're 99. But again, you could still trade these strong, powerful stocks because we're going to be putting stops at 3%, 5% max, only risking 1% of our capital. And I would rather take multiple trade attempts on one of the strongest stocks in the market and get stopped out a couple times before finally getting in and being able to hold it for a long period of time than trading 5 different B plus names with lower relative strength, weaker fundamentals, all that stuff, without aligning all the probabilities, and get stopped out of 4 of them and not make as much on the one winner. So like with ENPH was a stock that after we got this gap up, I kept on finding ways to get into this trade, and eventually it rolled over. But during this uptrend, because I was able to get so much size on it, because it was the leader of at the time, it was my main focus, and I would rather take 3 or 4 times with 1% or 2% stops and getting stopped out, and eventually getting money into the top ideas than to trade something that wasn't quite as strong. Let's see. Energy space, especially oil, should be strong. Many predict oil to go to $100 a barrel. Yeah, and to be totally honest with you guys, I don't trade oil stocks that often. They came up on all my relative strength scans today, so that's why I wanted to go over a couple that were hitting, that were still showing relative strength, that were in patterns that I would be interested in trading. But I know there's a bunch of geopolitical stuff that goes into the price of oil. Those are all things that I am not an expert at. Don't have much experience with that. So just being straight up with you guys, I wanted to bring it up because it is the group that's showing the best relative strength. But I don't know if I'm going to be trading it personally because it's just not my strength. SBSW. Yeah, see, these are like all over the place with the gap ups and gaps down. I don't know if I want to hold on to anything like that. Yeah. So same with gold. It's not something that I'm very familiar with. And the chart just shows there's enough gap down risk where I would just rather sit on the sidelines and wait for the stocks that I'm typically trading to set up. Or I can just go short on the names I'm familiar with, how they trade, that are in clear downtrends after they bounce back up to key areas of resistance. ZIM, yeah, this is one that's still on my general watch list. After it broke under 60 on, that was I think Friday. Yeah, on Friday. That was disappointing to see because it was kind of the last leader. We had Ford leading, and then broke down, and then eventually ZIM broke down. Bounced after the 50-day moving average, so still above the 50, but we're below a declining 21, below declining 8. Could still firm up and then eventually break over 60 again, and we could trade it. It's one of the stronger names in a strong group. So I definitely have it on my general watch list that I scroll through each day, but I guess a break over 60 would be the area that I'm looking at as a tradable entry point there. Let's see. CVX. Yeah, another oil and gas name making a new high. It has earnings in 3 days. I don't know how much earnings affect these companies, but MarketSmith is showing that its earnings is in 3 days, so you got to keep that in mind. Anything ARK owns, yep. Anything ARK owns, I want to at least have on a list, getting ready to short if it pops into key areas here. Yeah, SARK. So if you can't short, say you're trading in your Roth IRA or any IRA, there is SARK, which is an inverse ARK fund, which, I mean, this is the uptrend that you want to trade, right? Not this. She had a great 2020, good start to 2021, but I mean, all of the stocks that are main holdings are in stage 4 downtrends. And those are all things that I want to completely avoid. Roblox. Yeah, Roblox is an avoid for me as well. It's under the 50-day, so I don't want to trade any stocks under the 50-day. At least from the long side, I might short this stock. But it's also under the 200-day moving average. This is just a clean downtrend. The problem with these major declines from like 140 to 60 is this has trapped so many traders at these higher prices that when eventually the market bottoms and it finds support, this is going to have to base out for a long time because it's going to bounce up, and then you're going to get two groups of sellers. The people that bought at, say, 85, selling for break even because then they can take the trade off for not a loss, and then they don't have to admit that they were wrong for not cutting their loss quickly. And the people that got in at 60 and went to 85, that's a 25, 30% gain. They're taking that nice profit. So with two groups of sellers, when you see these massive declines, you get longer bases and typically more choppy. And that makes it very tough for swing traders to make consistent profits. So one that I wanted to kind of show was PLUG. This one went from 75 to 18. And then you could see how it rallied, sold off, still basing, selling off. Some of these stocks don't come back. Now, will Roblox come back? Maybe. I have no idea. But the larger the depth of the base from high to low, the longer that base is typically going to have to take, and the more choppy it's going to get on the way up the right side. So there are some stocks that sure make a V recovery, but you have to think in probabilities. The stocks that make these larger declines, they need more time to heal and to eventually shake out all the loose overhead supply before making a new uptrend. So when we do get back to a strong market, we want to be buying the stocks that have pulled back the least, are above key moving averages, pulled back on low volume, and ideally are about 30% or so off their highs. I mean, the less, the better, right? If a growth stock's only down 20%, while the index is corrected 15%, that would be awesome. But usually 40% is kind of my line in the sand. I will trade stocks that have pulled back 50%, but I'll trade those knowing that they are going to have a very rough time building out the right side of the base. So like with Fubo was an example of this. Huge move in the beginning of 2021. And then right through here, you see this nice flag area. I traded this, but I was selling into strength almost instantly. The first 4 days, I made 10%. That was like my goal on the trade, not to ride it for a massive win, because I knew it went from 57 to 14, and it was going to need tons of time to actually build out. So you can trade these intermediate moves, but just have a quicker profit target, move your stops up to your entry a little bit quicker, and just realize that it's typically not a pretty base when you decline more than 50% from the high. Let's see, CDEV. Oil and gas, nice, beautiful breakout. Yeah, you guys are crushing it finding these oil and gas stocks. Ascending base on the weekly, what does the fundamentals look like? Let's see. So fund ownership rapidly increasing, 106 to 308. Starting to taper off a little bit, but now with oil and gas soaking up more of the money, maybe in March's numbers we'll see that elevated. Number one, relative strength 99 right there, so 1 out of 56. Good volume, 7 million shares traded, so it's not going to be whipsawed as much as a thinner traded name. 88. Composite rating, not as profitable as some of the names in the group though. Let's see, weekly. Ascending base, yep. Yeah, so I mean, I just don't know all the geopolitical stuff that goes into trading oil stocks, and yeah, we'll see. How about SoFi? Yeah, SoFi was a stock that I shorted as well. It was one of those names that were under their key moving averages, under the 50-day, under the 200-day, and then it had good news, and good news in bad markets are selling opportunities or short opportunities. I think they passed some legislation. Actually, we could check MarketSmith to find this out. Long-awaited, so you just click on the news sector here. Long-awaited bank charter will make business better. Basically, they got the regulation passed to become a bank or to act as a bank. So it popped up. It went all the way up to 1647, and look where it stopped, right at the declining 50-day simple moving average. There's a couple areas to short that, or when to short it. I shorted it, I think this was the day that it actually got the news, and then it ran the second day, but I shorted it on both of these days. Again, I'm not doing a great job at holding onto my shorts because there's still like that oversold sentiment in the market, so I'm expecting a bounce. Don't want to stay in anything for overnight gap risk. So this wasn't like an amazing trade by me by any means on percentage gain or dollar gain, but it was an income generating trade. And when you get good news in a bad market, stocks typically use that to, or institutions or traders typically use that good news to sell into the strength. And you could see that with that, just that kiss of the 50-day simple moving average before selling off here and then making a new low on Monday. So this is one that's declining. Don't want to touch it unless I'm trading on the short side. Yep. Let's see, VAXX. Let's try the E-Trade chart. I am not getting that stock in either trading platform. Do you know the name of the company? I can search that up, Dean. But we got about 8 more minutes. What other stocks do you guys want to see? Anything you want to talk about? Risk management techniques? Books that you should absolutely be reading. You can see I'm about halfway through my third time in How to Make Money in Stocks by William O'Neill. Great book to read. There's a bunch of other trading books that I've been working through. So when the market's not right, you could still make progress, not in your account balance, but with your trading style, by reading, by going through your past trades in 2021, going through all of the mistakes that you made. What I was really noticing, and I've talked about this before, is looking at like IWO. This was a complete chop fest in 2021. And what I did very poorly, basically after February, was I wasn't putting on risk quick enough and selling into strength quick enough to make good gains through this. I was starting my positions at 5% of my account, building up 1, 2, 5, 7, 10, 15 positions at 5. And then right when I would do that, the market would turn. So that's something that I took away from going through all of my previous trades and breaking down 2021. And these are things that you guys can do on your own while the market's in a downtrend, while we're seeing unfavorable action in the market. Use the time to sharpen up your trading tools so you're prepared when the market is right to start pressing on the gas. Do you only flip